Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Even as the world grapples between lockdowns and unlock, the situation in India seems a lot more benign. Add to that the fact that global commodity prices continue to rise, supported by the Chinese macro data and positive vaccine news. And we certainly hope for more positive news on the vaccine front from a health perspective. The point of the conversation today, or the talking point today, is what does all of this mean for suppliers of the growth engine for the world economy to get back on its feet? And that includes almost all forms of commodity, including metals. Now, steel has been in a big up cycle in the last few months, ever since the unlock came into being. The question to our guest today would be, where does he believe we are in the current state of cycle? And how does he see the next year shaping up to be? Mr. Seshagiri Rao needs no introduction. He joins in to talk as much about JSW Steel as about the industry as being one of the foremost players in the country. Mr. Rao, good having you. Thanks so much for joining in and hope all is safe.
Everything is fine. Thank you very much for inviting me.
The pleasure is ours, sir. Just let me start off with that. Everybody's talking about the steel cycle or the metal cycle now showing firm legs to carry on for a lot longer. To your mind, where are you, or where is the industry in terms of the cycle? Which stage of the cycle are we in right now?
In my view, we are in the midst of the cycle. If you see in the beginning of this calendar year or just after the COVID, everybody felt that whatever recovery that we are seeing is only in China, whereas the rest of the world is still struggling. That was the understanding. But as the year progressed, if I see the October numbers, the production has really picked up even in the rest of the world. So if I see the total production in the month of October, globally crude steel production, 162 million tons. Out of 162 million tons, if I deduct the production from China, which is 92 million tons, the rest of the world produced 70 million tons. So if I see the October 19, the production in the rest of the world was also 70 million. That means in the month of October, the production in the rest of the world has also picked up. But in spite of that, what we are seeing is very strong prices in the global markets. They're continuously going up. And there is a shortage of steel, which we have been experiencing in almost all the markets. If I say in the month of April, May 2020, first time we have seen the steel prices in Europe and also in USA were lower than China. It was never happened in the past. You look at today, it is reversed again. That means old system has come back. European and US prices are higher than China. So today, it may not be right to say that only China is driving the whole thing. The recovery is across. Then the demand may not be so strong compared to pre-COVID levels. So there are two important reasons why we are seeing such a robust recovery and outlook for the steel sector. Is that during the time of COVID, almost all the inventories which are lying either at the service centers or with the user industries or with the manufacturers, they are almost got exhausted. Inventory levels have come down so low, lower levels. So now everybody wants to restock. That is one particular demand that is coming up. So one side, a slight recovery in the demand in the user industries, either you take automotive or you take machinery or you take construction infrastructure sectors. There is definitely a recovery, may not be pre-COVID levels, but that is more than offset by a huge demand on restocking. So this restocking, in my view, will continue at least another 2 quarters. By the time normalcy will restore, that's why I'm saying we are in the middle of the cycle. So once the restocking cycle is over, the demand, once it comes back to normal, I think that things will look much better in the next calendar year relative to what we have seen. This is the reason one. The second one is iron ore, cost push, which is also driving up the steel prices. So iron ore, as you all know, one is shortage of iron ore because of Brazilian supplies got affected. And China is importing more iron ore than what they have done in the year 2019. So both together, has really moved up the iron ore prices from $83, which we have seen in the month of May and June. Today it is almost close to $138 per ton. So that is the kind of increase in iron ore prices. At the same time, because of the restrictions which have been put by China on import of coking coal from Australia, so they are more relying upon other than Australia for coking coal. The difference between international coking coal prices vis-a-vis what China is importing, there is a huge difference. Just to give you a touch of what is happening on the coking coal prices. When international coking coal prices, FOB Australia is around $100 to $102 per ton, the Chinese coking coal prices are $211 per ton. So that is the kind of difference in the coking coal prices. So very high coking coal prices, very high iron ore prices, shortage of steel. These are the three factors which is driving the steel markets right now. So this situation, in my view, is not going to disappear in the near future. So I'm looking at next year very optimistically for steel sector.
Well, that's as comprehensive as it can get, and thank you for that. I'll just pick up two or three points out of that and ask you some follow-ups, Mr. Rao, and then a couple of questions on JSW. One is demand thing that you spoke about, uh, with a presumption and by the way, as you said that the restocking demand can last for a couple of quarters. What if, let's say, for example, in India or the world over, the actual end user demand, but auto demand has anyways come back, but if the construction demand comes back immediately, let's say Jan, Feb, because this is typically the busy season, and if the end user demand also comes back, do you reckon there could be a really sharp upward pressure on prices led by demand, both from restocking as well as from the end user industry? Can both happen simultaneously?
Today, industry as a whole, if I see the capacity utilization in India, is in the range of around 75 to 80%. So there is still some more capacity that would be available. This can become operational. In India also, the problem is shortage of iron ore. Even JSW Steel could have done much better in terms of production and sales if iron ore is available in India. So iron ore story for Indian steel production improvement is very important. So whatever we are seeing today is on account of that. So if demand recovers, we hope the iron ore supplies will also get normalized in India. Today I came to know that Donimalai iron ore mine in Karnataka restarted. So that is great news. So 7 million ton of incremental iron ore comes into the market. So I think in the next few months, if iron ore supply restart, then automatically steel production also will improve. So then even after improvement in the demand for steel from the user sectors, I think India will be able to meet its domestic requirements.
Got it. But should that not happen, there is a probability that there could be a sharp pressure on demand for steel, and that might, if not elevate prices from where they are right now, certainly gives a bit of a cushion to any kind of a downtick in prices, because demand certainly seems to be there.
Demand is there. As far as Indian steel prices are concerned, they always track the international prices. So otherwise imports will flood India. Therefore, as on date, if I compare whatever global prices are there, landed cost basis, Indian domestic prices still are at a discount. So just to give you a feel of that, international prices, which used to be $397 in the month of June 2020. So today we are seeing $625 in China, FOB I'm talking about. So that is the kind of increase in steel prices. Corresponding increase in steel prices in India has happened? No. So Indian steel prices still not improved so much with compared to the global prices.
You reckon we'll get there, Mr. Rao?
It depends upon recovery in the domestic market. I think if domestic demand recovers and the steel prices remain at elevated levels and cost pressures remain as they are today, so there is every possibility that Indian steel prices can go up further. And cost also is very important. Iron ore price in the month of June 2020, which was 1960 rupees. In the month of December, it is 4,160 rupees. It is more than doubled. It is 106% increase. So there is a cost pressure also which is pushing the steel prices higher.
Agreed. And now I was going to come to that, but just one quick follow up there, and again on the demand side, what is your sense when you speak to your end user industries, sir? Because the common belief was that hitherto is the auto demand which has come back, and now construction demand will come back. We are in December. If construction demand has to come back in the period of December to May, then surely companies have sounded you off. You kind of have a sense of that, and you anyways follow the economic cycle a lot better. You reckon we are at the beginning throes of the construction activity pickup showing in the steel demand?
The construction, real estate, and infrastructure sectors, where all the projects came to standstill during the COVID time, the migrant laborers left the
Yes.
sites. Now everybody has come back. So there is recommencement of work on these projects. Either you take metros, or you take bullet train project, or even highway road projects. There is activity started. So these also get reflected by way of a good demand for TMT, which goes into the construction sector. Even prices of TMT, which is lagging behind the flat steel prices, they also picked up in the last 1.5 months, if you see. So these are all indications that these sectors, particularly construction, real estate, and infrastructure sectors, and large infra projects, they have commenced the work, and good demand we are seeing for TMT from these segments of the market.
So you reckon the average realization, sir, for JSW Steel, let's say, or for the industry for the October-December quarter would be would be quite a bit higher than what you've seen in quarter two? Because quarter two itself, I thought there was a bit of a pickup.
Quite a bit higher is a relative term, but I can say that they're better than quarter two. So whatever increases that has happened in the quarter two, they are not got fully reflected in Q2. So that full benefit will come in the Q3. Plus whatever increases we have done in this Q3, plus the long-term contracts with auto sector, they got repriced on 1st October. So those benefits will get reflected in this quarter.
Got it. The other small question that comes along with this, as you referred to, that costs across the board have inched up on the raw material side. And I reckon that even though India Inc. and all you large corporates did a tremendous belt tightening exercise, some of those costs also would have come back in quarter three, I reckon, naturally so. How do you see the operational metrics then evolving in light of the fact that, yes, sales and prices are moving up, but at the same time, the cost pressures are also moving up?
Cost side, iron ore, as I mentioned to you, has gone up quite substantially. It is 106% increase
Yes.
from June to now, December. So every ton of steel requires 1.8 or 2 million, 2 tons of iron ore. So there is a huge impact on account of iron ore increase in cost.
Right.
As regards to other areas of efficiency, we have been working on that. So we have given a guidance in the beginning of the year that we will achieve a cost reduction other than these raw materials between 10 to 15%. So we are on target. We were at 9% in the quarter two. So we are working in that direction to reduce the prices, reduce the costs other than raw materials, which is not in our hands. So we are working in that direction to improve operational efficiency, to improve the fuel efficiency and reduce the cost. But at the same time, the coking coal prices have come down globally. So that benefit of lower coking coal prices will also get reflected in the cost, to some extent neutralizes the increase in iron ore cost.
It may actually not be that bad in operational scenario as well, even though some of the belt tightening measures would have come. I mean, you would have had to reinstate them, and the iron ore prices have moved up, but there are other factors which may help you negate those effects.
It may not be necessarily for all the companies, but yes, some of the steel companies can show better margins.
Okay. Fair call. The other bit, and just a slightly longer term question, Mr. Rao, before I get back to the here and now, and that is this whole belief that with this, I mean, everybody now assumes that you will probably do that quarterly run rate of 4 MT, and therefore the sales guidance you will easily beat whatever, and therefore the net debt reduction that you guys have spoken about, you will easily do that, and add to that. The fact that while there are price hikes and further price renegotiations with the automotive industry, that might also help you. So all of that put together, and I believe there's a pellet plant, the commissioning of a pellet plant that you would do as well. Would all of this help you over the next 4 quarters in calendar year 21?
It will definitely help. There are a lot of things happening in the company which I last time elaborated. One is expansion in capacity by 5 million ton that will get completed by end of this financial year. Over and above that, the pellet plant we already commissioned. It is a large pellet plant of 8 million ton
Million tons, yes.
At Vijayanagar. We have already commissioned that. So that pellet will replace the lumps which we are buying in the market. So that will reduce the cost. Similarly, we also expanded our capacities in the downstream. So part of it got commissioned, balance will also get commissioned. Our capacities are going up from 5 million ton to 9 to 10 million ton, including Asian Color acquisition, which we have completed. We're almost close to 10 million ton. That means our downstream capacity is almost doubling. Downstream includes galvalume, color coated, so many other downstream products, which gives higher margins to us. That is also coming. That also is coming in next year. So incremental volume plus change in the product mix plus lower cost of production. These are the benefits which will flow in the next financial year. I think we are at the right time when the capacity is coming up and the economic recovery will happen in the next financial year. I think these are very good things for the company.
Yeah, the Reserve Bank was on record saying today that the economic recovery looks alive and kicking, and they were referring to growth as well. Actually, did the policy please you, Mr. Rao? The Reserve Bank not once spoke too much about concern about the liquidity measures. I think the rates picture doesn't seem to be that aggressive or hawkish. If anything, seems benign. And the RBI did mention growth a number of times in the policy. Is that conducive to large corporates wanting to take some risk, set up some plans if they need to? Not in your case, but I'm just generally saying, is all of that conducive to corporates growing better?
Lower interest rate regime is very good for the industry because it can stimulate the demand very much. So if you see in the year 2000 to 2007, in that cycle when interest rates were lower in India, I think huge amount of investments happened in India. So today, immediately investments may not happen. There is unused capacities in almost all the sectors. So in the next 1 or 2 years, the situation comes in, first demand will pick up and that will take away the unutilized capacities that will get absorbed. Then investments will happen. It is a matter of time. New investments will come in.
Yeah, and I want to hope that the iron ore capacities come on stream quicker for you to actually move up your capacity utilization levels as well. But assuming that that happens, Mr. Rao, my final question really, what's the level of internal buoyancy that you have with regards to earnings growth for the next 6 quarters, sir? I mean, you mentioned that we are in the mid of the cycle, and therefore the peak is not yet there, and capacities will move up, prices will probably stay higher or move higher. What kind of earnings growth do you see for yourself? Because you're also reducing debt at the same time.
Look, here in JSW, one is volumes. Volumes will increase going forward. Number two is the integration of iron ore mines. We have 4 mines in Orissa, all 4 are operational, and 9 mines in Karnataka, all 9 are operational today. So we have 13 captive mines. So in the period of last 6 months, if we have survived, it is only because of these captive mines, even though it might not have given to us a big reduction in the cost, but it ensured supply, at least to some extent. So once logistics are stabilized, I think it is a great benefit which we can get on account of integration of these iron ore mines. So volumes plus product mix plus iron ore mine integration will definitely give a good benefit to the company going forward.
Well, I'll try and read between the lines, but I think you've said quite a bit already, sir. Thank you so much for explaining some nuances about the global scenario as well, the China import piece and the numbers thereof. And all the best for the new calendar year. I hope it is even better than what the last couple of months have been like.
Thank you. Thank you very much.
The pleasure is ours. Thank you so much for coming today. And viewers, thanks for tuning into this edition of The Talking Point.